Hi, welcome back. This is Judith Paquette, Part 3, Accounts Receivable. We are going to talk about how we estimate bad debts using the AR aging method and the percent of sales method. And as a review, we cannot use the direct write-off method for writing off accounts receivable unless you are a very small company. We use the allowance method. We estimate what our losses are at the point we make our sales or at the point we issue our first financial statements. First method, accounts receivable aging method. The percent of accounts receivable estimate is calculated by multiplying a percentage to the current accounts receivable balance. This can be done against the whole balance, which is kind of a sloppy way to do it, or in a better way, we use the accounts receivable aging schedule. The aging schedule is more accurate as the percentages will vary and increase the older an account gets on the schedule. Let's take a look. Imagine you are a company that sells pizza and you sell to the Microsofts or the Amazons and they don't pay you at the door. They just have Garlic Jim's just sends you a pizza. Garlic Jim's just sends you an invoice. So at a point in time, Garlic Jim's Pizza has many invoices from its customers that have not been collected. They totaled $620,000. And they are equal to the balance in the accounts receivable T account. As you can see, most of these are current. $454,000 is current, which means in the United States it's from 0 to 30 days old. Again, to the far left is $620,000, the grand total. But you can see that there's $454,000 current, $102,000 that are 1 to 30 days old, $30,000 that is over 60 days old, and $34,000 that's over 90 days old. Okay, so think about that. Garlic Jim's has invoices from customers that total up to $34,000 and are over 90 days old. It is likely that some of those will not be collected. So we age all the invoices, and these are all a bunch of invoices. There can be more than one, adding up to $454,000, not just one big party, but many, many invoices from many customers. And the people in the credit department determine that 2% of the current accounts receivable will be uncollectible. 7% of the over 30 days will be uncollectible, 30% of the over 60 days will be uncollectible, and 50% of the over 90 days will be uncollectible. The older the invoices get, the more likely they are not going to be collected. So we multiply out these numbers and we get 9,080 in the current column, estimated uncollectible, 7,140 in the over 30, and so on. We add these numbers up and we get a total of 42,440 estimated uncollectible. Now look at these T accounts. 620,000 was what I told you was the balance in accounts receivable. Let's assume bad debts beginning balance is 0, and the allowance for doubtful accounts, I'm giving you that the beginning balance is 17,000. Okay, so we have to build the journal entry for this. This is the balance in the allowance for doubtful accounts before making the journal entry. Now remember from the previous page, the estimated uncollectible accounts are 42,220. Our journal entry to estimate bad debts using the AR aging method is 25,220. because the T account already had $17,000 in it that had not been used. Maybe it was left over from the prior year. We didn't have as many write-offs as we had estimated. Okay. So it's important that you know that when we're using the AR aging method, it's the ending balance that has to equal our estimate, the ending balance in allowance for doubtful accounts. So if our beginning balance is $17,000, our journal entry is going to be $25,220. We posted it to bad debt expense, posted it to allowance for doubtful account, and you can see your ending balance agrees to your estimate. We did not touch accounts receivable because it's not part of the adjusting journal entry. Bad debt expense. Let's practice. What if the balance in the allowance for doubtful account is not a credit balance but a debit balance? This would mean that we estimated a certain amount for bad debts and we actually had more write-offs than we had money for. So we have to take this into account as well. So at this point in time, we're saying bad debts are estimated to be 10% of receivables. Now, it's better to age the receivables, but sometimes you just take a flat percentage of the total amount. 10% of 30,000 is 3,000. That is our goal. But our journal entry is going to be 5,000 bad debt expense, allowance for doubtful accounts, because we have to take into account the beginning balance of allowance for doubtful accounts. Let's look at the T accounts. Beginning balance 30,000 for accounts receivable. Beginning balance allowance for doubtful account 2,000. Now remember, the normal balance for allowance for doubtful accounts should be a credit balance, but as I said, we wrote off too many in the previous quarter or month. So our journal entry has to take that debit balance into account because our goal is 3,000. So to get from 2,000 debit to 3,000 credit, we need 5,000. All right, let's look at the other method to estimate bad debts. This method is called the percent of sales method. The name of the method shows the calculation. You take a percent of sales. I do want to stress that it's not all sales, it's credit sales. All right, so let's look at them. On June 30th, Martinez Company had monthly or yearly if it's year end. If its year end is June 30th, net credit sales of $2,400,000, and it estimates that 2% of these credit sales will be uncollectible. The journal entry to estimate bad debts is 2% of $2.4 million or $48,000. Simple, right? You don't have to take into account the beginning balance, you just book the percent of sales. This ends part 3.